Good
We
morning
can
again.
start now.
On this chilly Saturday morning, I welcome you all to this webinar. I hope it will be very much interesting to you all. Welcome, Mr. Vikas Singh. I take the privilege of introducing Mr. Vikas Singh to this august audience. Mr. Vikas Singh is a mathematics graduate and he is an actuary also. Um, Mr. Vikas Singh is an actuary and insurance consultant with over 15 years of experience specializing in the life insurance and employee benefits. His expertise spans product development and pricing for life and health insurance, employee benefits, evaluation, incentive scheme, the evaluations, and actuarial process audits. Mr. Vikas excels in collaborating with the global clients to manage regulatory filings, drive strategic business projections, and establish successful insurance and insurtech ventures. With a passion for innovation, he also provides consultancy on leveraging technology to enhance insurance operations and customer experience. So, with his very rich experience and global experience. I'm sure that to say this webinar will be very much interesting to us and very much educative and informative to us all. Now the forum is open to Mr. Vikash to take over.
Thank you, Mr. Prasad. Thank you for the kind information, kind introduction. Uh, and I see there are many people still joining. Should we start or should we wait? Or we have expected, are we expecting more people to join in?
Yeah, but then in the meanwhile, I take this opportunity to introduce our two of our forthcoming programs to the members. Next month, we have got one event in Kochi. First at Chennai and another at Coimbatore. The next month, 11th, seminar is at Kochi for one day. And in the month of February, on 14th and 15th, we got a 2-day residential workshop at Coimbatore. I request all the members to avail this opportunity to and gain rich experience in different topics covered by the eminent personalities on valuation. I advise you all to book your slots well in advance so that you will have an opportunity to attend the meeting without the event gets closed, bookings gets closed. If any of the participants are not members of the BVA, I request everyone to join. This is a forum where various topics on valuation are covered every fortnight on second Saturdays and fourth Saturdays religiously. So there is not even a single fortnight on which the event has not taken place. So that is the punctuality, that is a commitment of the organization and the members and the MC team uh, to conduct such knowledge sharing webinars. And it is because of all the interest of the members who are joining, either as members or just as a simple participant. I request every one of you to be part of a Bangalore Value Association and gain knowledge and also share if you can. Shall we start? It is already 7:38.
Yes.
Sure. So thank you, Mr. Prasad, and thank you for Bangalore Valuation Association for inviting me for this webinar and giving me opportunity to present on this topic. I see there are very experienced faces and names, and my experience is nothing in front of you people. And we would have like valued many companies and many properties, I guess, and you also would have come across the valuation of life insurance company. I would, with my little information, would try to keep it less technical and more general terminologies I will use so that you understand the key concepts of valuation of a life insurance company and the terminologies used in those valuations. Can I share the screen now? Yeah. Let me know when it is visible to you all.
Yes, now it's visible.
Thank you. Yeah. So we'll start from here, and I would like to cover these five action items on my presentation today. The key components of the valuation. Obviously, it is very important to understand what it takes to value a life insurance company, and those components are the EV and value of new business. So I'll try to explain in a very non-technical terms what EV is and what is the value of new business. And we'll also touch base what are the key assumptions and to derive those values because we know that like in unlike any other business, life insurance business is based on lot of assumptions because of its long-term nature. Uh, it's not very straightforward income and outflow like any other business, right? So we have to make certain assumptions to understand how the output would be in the current year and in the future years. And we will also see a market case study. We'll see how much value insurance company got listed through an IPO and how their value was given in the public domain. So, talking about key components of the valuation, the total value is basically identified by two components. One is the EV, the embedded value. In India, it is slightly modified, so we also call it Indian embedded value, IEV. And the second component is basically projected VNB, and you can say goodwill or the number which is reflecting more of a future business and not the current business of the company. So embedded value is basically whatever has happened in past and till date of valuation. And projected VNB is basically whatever is expected to happen in future and after the date of valuation. So if you take an example of HDFC Life, uh, after listing, the value is basically measured through market cap, and at the time of IPO also, the value is measured through market cap. And HDFC Life got listed at a market cap of 58K crore, 58,000 crore, and out of that, the embedded value was basically 12K crore. So we can see that HDFC Life got listed on 4.7 multiple of EV. So basically, this is a common terminology used when we value a life insurance company. The total valuation is seen as a multiple of EV, and higher this multiple is basically represents higher confidence, higher goodwill value, and a kind of higher growth rate in the future. So while the private companies like HDFC Life and ICICI Prudential, SBI Life, they got listed at the EV multiple of 4 and above. The public company LIC got listed at the EV multiple of around 2. So that also tells us how aggressive we are in assuming the future growth rate of the company, future growth of the company. So in next slides, we will try to cover both embedded value and Indian embedded value and projected VNB in detail. So again, when we come to embedded value, it have two components, and it works as a baseline number, or you can say the very crucial number while valuing the insurance company and while assessing the value of an insurance company. It is very widely used across globe by the investors to understand what kind of profitability an insurance company is running into, and how it is growing in future, whether it is a long term or whether it is a short term business, all of that. So, as I said, Indian embedded value or embedded value again have two components to it. One is the value of in-force business, and one is the adjusted net worth. We'll touch upon both of these figures, both of these parameters, and understand how they basically uh, get calculated and how they come to the picture. So value of in-force business, very popularly said VIF in the insurance world and its actual terminologies. VIF is basically present value of future profits. So if I am present value of future profits for the business that company have already written, VIF value of in-force business. In-force is the policies that have been already written. In-force uh, doesn't reflect the status of the policy, even if the policy is basically reduced, paid up, or surrendered or lapsed, that will be considered as enforced. So here in enforce, by enforce, we mean that whatever policies have already been written, for which the premium have already been received by the company, or the policies have already been issued by the. And since the life insurance is a long-term contract, be like 10, 20, or 30 odd years, uh, uh, the every value or every cash flow is seen in terms of present value. The income it's also is a present value of future premiums. Interest income is also present value of future interest incomes, and all expenses, benefits, and everything is basically seen in the present value terms. Unlike other companies where we see the cash flows in the real terms while calculating the current market value of a company.
Mr. Vikas, I have a doubt here.
Yeah, madam.
It is similar to the discounted cash flow method, similar. So, what should be the
It is
projected period?
discounted cash flow method.
So, what should be the explicit period or the horizon period for which I have to discount the cash flows?
So for VIF, man, generally the projected period is based on the policies we have written. So if we have issued a policy of 10-year term, the projected period for that particular policy would be 10-year term. So, and
But I
VIF is
think so many
calculated
policies
corresponding
would be
to.
there. No?
Yeah, so basically, I'm talking about VIF, which is policies which are written by the company, which are issued by the company. So, and this is calculated against each such policy. So, if some policy is say sold for 30 years, their projection period will be for 30 years. A policy is issued for 12-year term or 10-year term, the projection period would be 10-year or 12-year.
But I didn't understand. There will be thousands of policies, no? So will
Yeah, so
the
we
insurance have?
calculate, so it is calculated for each and every policy. So consider this as a basically if I have bought a policy for 1 lakh premium per year and for 10 years, right? So now for against this policy, the VIF will be calculated. Similarly, if there are lakhs of policies, the VIF will be calculated for each and every policy.
Normally, what is the purpose why we do this? Because listed company we have this market approach, na? So
Yeah,
any
listed
specific?
company, we have this market approach, but see, if investors want to see whether the market is overvalued or undervalued, they will see what is the market value as against the EV or IEV. So whether that multiple is basically above 4 or it is above 2, because at the time of listing, the company was listed at the multiple of 4. Now, if current market scenario, my market cap vis-a-vis the IV is less than 4, then the company could be considered as undervalued and maybe investable. And if the multiple is above 4, then that company can be considered as overvalued. So, and this 4 is basically a basically random term. We are using 4 because if the company was listed at the multiple of 4, that can be any multiple basically picked up by the investors based on the global investment. global
Benchmark.
experience.
Yeah.
Yeah, benchmark. So if the multiple is 2 or 3, any company where the market value is 3 times of IEV would be considered at reasonably value. And otherwise, basically, if it is lower, then undervalued, and higher, then overvalued. So as long as VIF is
Can
concerned,
I,
BIF is concerned,
I have a question continuing to this. Projections is
yeah,
never
yeah.
a problem, but
Mm-hmm.
beyond the defined explicit horizon, what would
Uh-huh.
one consider as the discount rate?
Beyond that, or like for the discount, for the whatever horizon we are taking, the discount, what
Yeah,
discount
see,
rate we are taking, right?
we have agreed for 30 years, for 20 years
Right.
projections. That's by the
Mm-hmm.
policy, we know exactly the amount. The projections are easier to do, but when we are
Right.
discounting to the present value, beyond the
Correct.
explicit period where we can reasonably define what will be my expected discount rate, what
Mm-hmm.
will be the, is there any thumb rules or basis of discount rate beyond that explicit period?
See, beyond that explicit period is basically we will cover as we move forward in the slide. Uh, Let us first understand the VIF in detail. Here, as you also mentioned that there's a discount rate which we use. So, like discount rate, there are also other assumptions which are important to understand. So, when we calculate the expected future cash flows to arrive at the future profits of the particular policy, we use these assumptions which are listed here, the mortality assumptions, basically that derives uh, what is the expect probability of death and what is the probability of death cash flow happening or death payout happening.
Sir, one
We
small
use
doubt.
labs and
One small
yeah,
doubt.
ma'am.
Now, the
Yes, sir.
expectancy growing up, should we say that in future insurance companies are more and more profitable than in the past?
Sir, I would probably urge to park your questions and maybe let me finish at least important part of the valuation and then we can take such questions. That would make more sense, I would guess. Will that be good or you want your answer right now?
Please continue your presentation and let us evaluate the questions later on so that your
Yeah,
flow,
yeah, that
your
would help
thought process
actually.
continues.
Yeah,
Your
yeah,
your thought process continues. And most of the
yeah,
questions
yeah.
probably will be answered as we listen to you. Thank you.
Yeah, yeah. Thank you very much. So, so VIF, as I said, it is a present value of future profit for the policies which are already sold by the company, and this is calculated on certain assumptions, mortality assumptions to understand what is the probability of paying a death benefit, or what is the probability of paying a survival benefit or income benefit, uh, depending upon what kind of product company have sold. If it is a term product, there would be only mortality death benefit. If it is a endowment product, there would be a death benefit, or there can be an income or survival benefit as well at the end of the uh, period. Similarly, lapse and surrender rate assumption is used to understand if there would be any surrender benefit paid in between the policies, or what is the probability of paying a surrender value or not paying, getting the surrender profit by the company. And similarly, all the expenses there are, because we cannot predict the expenses precisely or in future, we take certain assumptions related to each policy, how much expense we would incur towards each policy. uh, that is also an assumption. And then because companies keep reserves, they would earn certain interest on the reserves, and whatever capital they will keep to support their business, there's an investment return assumptions. And then there's a discount rate. Obviously, discount rate is basically a risk discount rate, which is arrived with some margin over and above the risk-free rate. So suppose if the risk-free rate in the current market is 7%, based on the GSEC yields, the risk discount rates are generally uh, cal determined by adding some margin to the risk-free rate, and it lies in the range of 12 to 16%, depending upon the riskiness of the business and the company's approach in determining the discount rate. So somebody also asked how we determine the discount rate. Discount rate is basically always added certain margin on the whatever the risk-free rate is in the current market. So the next component of the IEV is basically adjusted net worth. So while the VIF covers all the profits coming from the cash flow, the adjusted net worth is basically what is the shareholders' wealth. Shareholders would have infused certain money, and then if the company is already profitable, surplus or profits would get added to that shareholder capital year on year, and certain expenses would be adjusted. So that is why it is basically adjusted net worth. The net worth of the company would be a shareholders capital, including the surplus. But yeah, because we adjust it with some of the expenses which are in long-term nature or which are ad hoc expenses, only uh, only occur once in a while. So that is why it is called adjusted net worth. So IEV is basically broken into two parts. One is VIF, which is value of in-force business, and one is the adjusted net worth. So one is basically how much profit I would expect from the business I have already written, and one is how much money basically company have in terms of assets and whatever in money infused by the company. So as we move, we can see when we move year to year, embedded value changes, because when I move from one year to another year, a lot of things changes. Certain policies would have got matured, or maybe death benefit would have been paid, or maybe surrender benefit would have been paid, and they would go out of the system. And company would have written new policies in last 1 year. So basically, that would add to EV. Basically, whatever new policies we will write, they will bring some new value to the pool, and whatever policies will go out, they would take away certain cash and maybe a profit, or maybe they would bring some profit by going away from the books, and that will add to the VIF. Similarly, if there is any change in assumptions, like I said, if investment returns or any of the assumptions which are seems to be updated based on the past experience, or any other reason for change, changing the assumptions will also have impact on the embedded value, because all our cash flows basically based the expenses, survival benefit, maturity benefit, surrender benefit, all are dependent on the assumptions, certain assumptions, and not very straightforward. And similarly, there are certain operating variances which are basically actual experiences against the assumptions, because the EV calculated as on last valuation date was calculated on certain assumptions. If the company's experience is different than that assumptions, the 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 year basically the company would experience certain gains or losses based on that experience as well. So that would also add or delete to the VIF. And similarly, adjusted net worth will also change year on year, because the from VIF, certain profits would move to net worth. Uh, if suppose there are policies who are got out of the books because they have matured, or because the death benefit has been paid on that particular policies or pool of policies, and whatever profit the company would experience throughout the year would be basically would go to the accumulated surplus pool, and will increase the shareholders net worth. And if there are any dividends declared or ESOPs issued, would obviously change the capital structure of the company, and that would also lead to change in the net worth. So this is basically everything about IEV. Uh, and as I said, IEV have two components: value in value of in-force business, and in adjusted net worth. So happy to take any question on IEV at this front before moving to the next piece of next part of the values.
Here, I have a doubt.
Yeah.
While you focused on the revenue stream,
Mhm.
how will you adjust the expenses specifically? You just said lapse or surrender rate definitely is a reduction in the revenue. Investment returns are also considered, is it, as a part of revenue? Normally, other income is not considered, but I think insurance, this is extremely important, right? Like for the
Right,
future
because they are
projected
going to
period,
pay.
no, investment. See, as a theory, this concept is very easy. But if I have to implement all of this in a practical scenario, just want to understand what are the assumptions I could take in an investment return. So today they are investing in one place. Tomorrow they will invest in another place. So in a horizon period, you are telling insurance and all have to take, say, 30-year period. So if I have to imagine an insurance policy of 30 years, and then how do I consider investment returns for that? Like,
So investment returns generally they consider based on the locked in yields. Though, so basically insurance companies, they don't trade on the investment instruments that they have invested. They try to keep the investments till the maturity, and based on the locked in yields, basically whatever amount they have invested, they arrive at the investment rate that can be used to estimate the investment returns over the future.
okay. Any
And
valuation report we can find in the net? Have you done any public company related valuation?
We won't find a complete valuation report. We would find EV, basically in embedded value, because what the listed companies they got whenever they got listed, their valuation is basically on a market value basis, market cap basis. Unlisted companies generally they don't print their valuation; they just print their EV, embedded value year on year, and the change in embedded value year on year in their financials. Uh, in one of the L forms they have to produce on their website every quarter. So we have a market study also, and how the EV is changing for a couple of companies in the towards the end of this presentation. And to answer your question on the expenses, we do while estimating the VIF, the companies do take assumptions for the expenses as well. So there are basically two kind of expenses the company assume. One is premium related expenses, also called as variable expenses, and fixed expenses, which is or basically absolute expenses, which is called fixed expenses. So variable expenses are those which are expected to change with the premium. For example, commission. If the premiums comes, then only commission will be paid. Or incentives. If the premium comes, then only the incentives will be paid. And the other fixed expenses would be like paying the salary, rent, etc. And all that is basically converted to a per policy expense.
How about
Because
the claim as such? Like if any claim is there, where will that be considered?
that would be basically part of your maturity mortality rate and this assumption. So if I am assuming a death probability of say 1 per 1,000 life, that means if I have a policy of 1,000, one person would die and I have to pay a death benefit of whatever sum assured I have written. And similarly, mortality assumption also reflects the survival rate. Basically, if I have one person, 1,000 people right now, 1,000 minus people died would be my survival benefit. So that into the probability of the benefit into the probability of survival would become my payout for the survival.
Is that
in
an
these
expense?
assumptions, if you it is an outflow, not an expense. It is a benefit paid out, basically. So mortality rate and lapse surrender rate is basically used for determining how much benefit is expected to be paid in future. Mortality and morbidity rates are used to uh, assess the expected benefits paid in future towards maturity, death, and other survival benefits. And lapse and surrender rate is used to assess the expected payouts towards the surrender of the policy.
It will come in balance sheet as a liability. That's what you meant, right?
These will, yeah, those basically in balance sheet, the liability would be reserve or present value of all the future expected cash flows. So VIF is basically VIF you can also consider as a reserves or liability of a company in certain sense, because liability is calculated on a slightly more stricter measures on a more conservative assumptions.
My question now on the discount rate, can you help?
Yeah, yeah. So discount rate, as I mentioned here, because we know precisely what is the discounted term based on the number of policies or based on the policies we are writing. The discount rate for that period is taken based on zero coupon yield bonds after adjusting for the basically forward rates and all. So and basically that becomes a risk-free rate, and the company also adds the uh, investor's margin over that. So in general terms, the discount rate used in the insurance world is basically 12 to 16%.
It's
Long-term
a
and risky contracts are valued at the discount rate of 16%, and the straightforward contracts or lesser term, basically, smaller term contracts are valued at the discount rate of 13%.
it's a thumb rule basis.
It is, in some sense, it is a thumb rule to use discount rate as whatever risk-free rate in the market plus maybe 50% of that as a risk-free rate, risk rate basically. 50% or maybe 75% of that. So currently, like discount rates are like in the range of 12 to 13%.
No. See, okay. So we are saying that risk-free rate. So beyond 5 years, the risk-free rate you are referring to is essentially a treasury security corresponding to the tenor, because we generally tend to have a tenor of 5 years treasury security, 10-year treasury security, so on. Okay, and you'll find very few of 20 years and 30 years. You won't find. Okay, it will be very few.
Yeah.
Okay.
Yeah.
So see, projecting till 5 years, 7 years is still okay. You are referring to a 20-year policy, you need to project till 20 years or some could be odd number. For an odd number, we can do a pro rata. But therefore, if I want to do a 20th year discount or a 17th year discount, for me to get the discount rate, where am I going to get? The single treasury security, if at all it is lying, I need to use that or something else is there? That was the question.
So they basically derive the yield based on whatever investments they have already made, the locked-in yield, and they also take reference from the market yields, whatever market yields are going on for those treasury yields, treasury bonds.
So they basically build the yield curve to beyond the available tenor in the market.
Yeah, they use
They
forward rates
construct
to
the yield
calculate.
curve.
Yeah. They construct the yield curve based on the forward rates available.
So provided you have the market for forward rates for so many years, right?
Yeah.
Provided you have the market for the forward rates for so many years with certainty, right?
Yes.
Okay, the second question is, you said adjusted net worth every time. Invariably, you are taking a value as on a particular date. So once you decided the net worth, what it would be, why would you adjust against some policies being matured and all that? Because that comes in the projected cash flows any which ways. Because if someone...
No, it will not be adjusted. It will not be adjusted towards the policies maturing or something. It would be adjusted toward any one-off expenses or expenses which are basically say suppose certain unrecognized gains and losses.
Okay.
The net worth would be adjusted towards that, which are expected to basically give you long-term value. Say suppose there is a change in regulation and insurers have to spend a lot of money in abiding by those regulations. These are one-off expenses, but going to have a long-term impact. So those expenses probably they will not go into the VIF. They would be adjusted in the net worth.
That is for year on year representing in the balance sheet you're referring to, right?
Yes. So adjusted net worth is basically derived from the balance sheet, right? Because whatever capital they have or the shareholder capital they have along with the accumulated surplus or losses, on top of that, they would basically adjust it.
Yeah.
Because all the expenses don't qualify for adjusting to the net worth, right? Because most of the expenses would go towards the VIF, already considered in the VIF. The expenses which are not considered in the VIF, or maybe some portion of those expenses are considered in VIF, those will be adjusted towards the net worth.
Excellent. And the last question from my side. There will
Yeah.
be so many investing companies will be there which are unlisted. So every investing company we need to do a thorough valuation like any other, like in every other case for determining the adjusted net worth?
I think yes, but as I said, the thorough valuation will be done, and basically the final value is determined based on the multiple of EV. So EV becomes base for everything, right? So thorough valuation or thorough calculation for embedded value and what assumptions are used to derive the embedded value, all of that is very important while doing a valuation for an insurance company. And after that, basically multiple is just a benchmark number you can take from market, or maybe can also be derived based on their future projections.
Thank you.
And we will come to that in the next slide.
So there is one
So as
question.
yeah, tell us.
So value of in-force business and technical reserves are same thing.
Value of in-force business and technical reserves are same things, or basically I would say is calculated in a similar manner and on a different assumptions.
By technical reserves, I mean that calculating our liability on best estimated
Exactly.
plus risk
So
margin.
liabilities are not calculated on the best estimate basis, while the VIF is calculated on best estimate basis. The value of liabilities or the technical reserve is calculated on a slightly conservative measures. So say suppose if I am using a discount investment return assumptions of 8% while calculating the VIF, I would calculate my liability on a slightly lower investment return assumption.
We say na that there is also a BEL and plus risk margin also in technical reserves.
That's what. So technical reserves के लिए I would keep some risk margin, or we call it MAD, margin for adverse deviation, over and above the assumption. So say suppose I am using a mortality rate of X for deriving the VIF, I would use different mortality for deriving the discount rate. So what I'm trying to say is methodology for estimating the number of value of in-force business or technical reserve is same. The only difference is the assumptions.
Oh, thank you.
Right. Hope this is helpful.
Mr. Vikas Singh, can I ask one
Yes.
question?
Yeah, sir.
Is there any approved body who gives this morbidity rates or mortality rates? And is it applicable for different regions for different morbidity rates, or is it same throughout India?
The Institute of Actuaries of India prescribes a mortality table. There are standard mortality tables for each country. There are some countries don't have, so they rely on basically neighboring countries' mortality table or UK mortality table. So similarly, we as an Indian institute have prescribed mortality table. It is called Indian Assured Lives Mortality, IALM. And they keep updating that mortality table based on the experience from all the insurance companies every 5 to 10 years. So the recent in standard mortality table available is IALM 2014 in 816.
Oh, it is so old during this COVID. During COVID times, lot of morbidity and mortality rates also must have gone up.
So they would adjust further that mortality table, right? So basically, this is the standard table, and every company would have different experience. So they would take certain percentage of that standard mortality table based on their expenses, based on their experiences, or based on how the reinsurance is supporting to them. So to give you a flavor, generally for a term insurance product, the mortality assumptions is used as 60 or 70% of the Indian standard mortality rate. Similarly, for a term endowment insurance product, the mortality assumption is used slightly higher because there's a less underwriting done, and the chances of and the life category is also different. So basically, the mortality factor is further applied on the standard mortality table to arrive at those assumptions.
Yeah. Thank you.
Okay. Yeah. So we'll move on. So the next component of the valuation is basically projected VNB, goodwill, which is also seen as EV multiple, as I told you initially, and gave example for a HDFC Life where the IEV was 12K and the value was 58K. So that gives a multiple of 4.7. So this 4.7 multiple is basically arrived based on how the projected VNB looks. And your projected VNB is nothing but your VIF for the business, which is expected to be written in future. So while VIF is whatever policy is written as on or till date of valuation, the projected VNB or projected value of new business is future business, whatever company is expected to write in future, and the profitability of those business is calculated as projected VNB and termed as projected VNB. So the methodology, the approach, the assumptions all are similar. It's just that the present profit is calculated, the PV is calculated on day zero before writing the business, and so on. Basically, if you are, and here the projection period is important. Whether the company is projecting it for 10 years or 15 years or 20 years, and how many years business they are projecting in their projected VNB. So basically, when we are saying projected VNB and we are talking about projected business, so what is also very important is what kind of business they are expecting, like what policies they are expecting. Every product have or category of product have different VNB ratio or percentage of VNB which is set. So they would have to assume certain portfolio, what percentage of term product they would sell, what percentage of annuity product they would sell, what percentage of savings product or endowment products they would sell, and what percentage of ULIP they would sell. This, while determining the product mix for future, they take reference from the past. It should not heavily deviated from the past product mix, which is used in the VIF. But the management have discretion to take certain or basically adopt certain strategy and change the portfolio mix over the period of maybe a projected period, 10 to 15 years. So while determining VNB, the product mix is very important because different type of products give you different absolute VNB or different percentage of VNB. I've given some example here like term products, which are pure, which are term products and critical illness product or annuity products. They are categorized as pure risk premium products. They have a higher PNB. Also because they have a lower premium. So their VNB is basically ranges between 80 to 100% or maybe 50 to 100% to give you a wider range. Similarly, ULIP and participating products, the unit linked products, and by participating products, I mean the products which offer bonuses year on year. Those products offers lowest VNB. They offer a VNB of range of 10 to 20%. So when I say a VNB percentage of 10 to 20%, that means present value of profits divided by 1 year premium. So, and similarly, the other guaranteed products, they offer a VNB in the range of 20 to 40%. So if a term plan is issued for a term of 10 years and the current premium is say 1 lakh rupees, annual premium is say 1 lakh rupees that policy is going to pay every year, 80 to 100% VNB means that company is expected to give you 80,000 to 1 lakh profit, present value of profit as on today. So that is why the product mix is very important, and VNB can basically change significantly depending upon the product mix. VNB percentage, I said, it is basically PV of future profits divided by the annual premium. For a single premium contracts like annuity and for single premium products like any endowment product or money back products, the annual premium is basically considered as 1/10 of the single premium to calculate the VNB percentage. Otherwise, the VNB calculated in the absolute terms. So that is there we don't actually require a VNB percentage. As I already covered, choice of products or assumed product mix is very important while deriving the VNB. And this after COVID-19, every company started focusing on term insurance products. So their VNB also got increased because increased focus on term insurance products and term insurance products having higher VNB. So this VNB basically determines what multiple would be appropriate for the company, or how much multiple would be. So suppose IEV is calculated, and then VNB is calculated for a 50-year projection, 15-year projection. Then IEV plus VNB would become your total market value, and basically that will determine what multiple it comes out of. And VNB or the product mix, or basically whatever assumptions they are taking in their future growth, the premium growth rate and everything, also suggests in some way or the other way what is the goodwill of the company, how faster the company have grown in past, or what is the market share of the company. Like for a company like HDFC Life would take a higher value, higher VNB, or take a higher growth rate as compared to company of a kind of Edelweiss, or maybe a smaller company like Bharti AXA Life Insurance Company. Because HDFC Life being an established company, they can assume a higher growth rate, they have a higher market share, they have a higher distribution network and all. The lower company, or the smaller company would probably have a lower growth rate, or maybe uh, uh, depending upon their product mix and their distribution network, they would have a different assumptions. So in some or other form, the projected VNB or projected value of new business also reflects the goodwill of the company, or whatever management strategy they have, how strong or weak their management strategy is. So would not spend too much time on value of new business, because as I said, to relate it, while the technical reserve, VIF, VNB, everything is calculated in a similar manner. All of them are basically present value of future cash flows. VIF and value of new business also includes your taxes and other stuff, while the technical reserve only includes the expenses and the benefits payout. And assumptions they use different for each of them. VIF is calculated on actual assumptions, uh, based on the actual past experience, based on the logged in yields, based on the experience, whatever past experience in terms of their lapse rate or expenses, actual expenses. Whereas value of new business is calculated on the projected expenses, based on the projected yields, based on the current market scenario, and based on the essentially the difference in all of this is basically how the assumptions are derived for each of the parameters. So this is important while we are talking about present value of profit in all two measures, VNB as well as in VIF. What is that profit is basically, and how that is calculated. So that profit is calculated as income plus income, which is basically premium income plus investment income. So whatever policies we have written, or we are expected to write in case of if we are calculating VNB. If we are calculating VIF, it is whatever premium we are expected to earn based on policies sold. And in case of VNB, whatever premium we are expected to earn based on the projected business. So well, the basis remains same. The premium income plus investment income becomes your inflow, and assumed expenses, which are basically commissions, premium related expenses, and fixed expenses, claim expenses, underwriting expenses, whatever rent we are going to pay, whatever salaries we are going to pay, all of that are comes under part of expenses. Commission, the distribution, the incentive to distribution channels, uh, all of that comes to assumed expenses. That becomes your one of the outflow, and then the expected benefit payouts. So what is the probability of paying death benefit, or what is the expected benefit that is going to be paid in future towards death, surrender, and survival, is also becomes one of the output. So if we stop at this point, this will give me the cash flow for technical reserve. And if I'll further go and add or transfer to reserves, solvency capital, and taxes, this would give me a profit to the company. So transfer to reserves, basically how much money I have to set aside for future expenses and future expected payouts, or maybe to pay the benefits to the policy holder. is reserves and transfer reserves. Transfer to reserves is basically a yearly cash flow towards that. Solvency capital is basically an additional capital which the regulator asks insurance company to keep over and above the reserves towards towards basically ensuring a better solvency for the company. Uh, IRDA, the regulator for insurance companies in India, specifies uh, factors based on which the solvency capital is calculated, and that basically calculated year on year. And if there is any change in solvency capital, the money is either infused or taken out of the solvency capital. And the taxes, there would be provision for taxes. So whatever taxes we are expecting to be paid in future on the profits are also becomes an output. So the net profit after all these becomes we also call it signature profit, which is then used to calculate the present values for VIF or VNB. I would like to take questions if anyone have any questions until this before moving forward, because we have covered a very key milestone up to here. We have understood EV, we have understood VNB, and we have also understood the components in calculating the EV and VNB, which are basically different cash flows that we use to derive the present values.
Mr. Vikas, recently I have done
Yes.
a listed company valuation. So just want
Yes.
to add some points for the benefit of everyone.
Yeah.
While we always think as a valuer, any valuation of a listed company, especially when the company goes for a private placement, is
IPO.
market based,
Okay.
but market based is
Okay.
only a floor price. The valuer,
Okay.
suppose I give the assignment to you, you definitely consider the market comparables, but you do all of this as well to understand
Yeah,
whether
yeah,
the
definitely.
so it's just a floor price. So even if it is a private placement, even if we have market price related data, still the value is expected to do all of this what you are presently focusing on.
Correct, correct. I mean, as an investor, if I want to invest, I would not only look at the market value, but the base number would be IEV, and then how the company is basically projecting their business. We have to take certain year-on-year projections. Obviously, there can be a surrogates to use if one is relying only on the investor's presentation or the publicly available data. But if an investor who want to do a private placement or maybe buy a, as you said, a sizable stake in the company, they would also get the more detailed calculation from the company and would do a further due diligence before investing.
Maybe ICTR regulations prescribe this valuation report.
Okay, okay. But this generally they don't make these reports public, right? They do only on a need basis such valuations, and generally done in consultation.
Under this ICDR regulation, that has to be disclosed. ICDR regulation expect the company to give it to stock exchanges, display in the website. But again, the purpose has to be private placement of a listed company.
Yeah, yeah. Okay. Okay. So the next, when we understood the profits, as I mentioned earlier, a lot of things are basically in an insurance company depends on the assumptions, and that is why these assumptions are very crucial. As I mentioned earlier, we take all of these assumptions in calculating the expected cash flows, the incident rate for perils covered, like if there is a mortality death benefit, the mortality rate is important. If there is a critical illness benefit or there is a disability benefit, then morbidity or sickness rate is important. And this not only determines the probability of event, the perils to occur, and the benefits expected payouts for those events. It also determines how much policies would get mature at the end of the term and how much survival benefit is expected to be paid. Because not all the policies would reach survival. Some would either would be like some would occur the covered incident. Some would face the covered incident, mortality or sickness, and some would get discontinued in between by through a lapse or surrender. So that is why it is important. These incidence rates are basically based on the standard tables, as someone asked and I mentioned earlier also. The mortality rate, there is a standard mortality table which is called IALM, Indian Assured Lives Mortality, which is uh, derived based on the past experiences of the insurance companies, as it is called assured lives. It is based on the lives who have taken policies by the Institute of Actuaries of India, and the table is prepared and printed every 10th year. Uh, they would do it for Indian assured lives and annuitants lives separately. The mortality table for lives who are withdrawing annuities are calculated separately and printed separately. So there are two standard mortality tables. One is Indian assured life mortality table, and one is Indian annuitants life mortality table. Annuitants life mortality table is used to value the annuity contracts or pension contracts, while the assured life mortality table is used to value the other contracts. So there is also guidance notes or actual practice standards issued by Institute of Actuaries of India to understand or to derive the basis for these assumptions. So the second assumption is basically policy discontinuance rate, which is also we also uh, call as lapse rate or surrender rate. Lapse rates are basically lapse is when the policy stop paying premium and there's no benefit, future benefit for the policy holder. Basically, they lose all the premiums paid, which is generally in year 1 or 2. And surrender is basically when they surrender the policy and they receive certain benefit out of the product. So whenever there is a lapse in the policy and there is no future benefits, whatever money left is basically a profit for the company. Whenever there is a surrender benefit paid out, the difference between the reserves what they have kept and the different amount they are paying to the policyholder, it becomes profit for the company. So it is very relative whether the policy discontinuance or higher surrender would give profit or loss to the company. Like if there are surrender profit, higher surrender rate may increase the profit of the company because profit may emerge earlier than later. So that would add to the profit and the present value will also increase significantly. So third is your expense. Uh, uh, in general, the insurance companies categorize their expenses as variable expense and fixed expense. Variable expenses are expenses which are linked to the premium. As the premium increases, the expenses would increase, like commission, their underwriting cost, the incentives they pay, the salary towards sales staff and everything. That all depends upon the premium income. So those expenses are categorized as variable expenses, and there are certain fixed expenses which the company is expected to incur even if there are lower number of policies or there are lower number of sales happening, like their rental expenses, electricity cost, uh, stationary expenses and all, marketing expenses. These are generally not linked to the premium, are basically categorized as fixed expenses. The company basically divide their total expenses into the uh, divide by the divide their total expenses by the number of policies as on particular date to arrive at the expenses. These fixed expenses and variable expenses are further categorized into acquisition expenses and renewal expenses, because the policies which are already in force, already in book, they would not have acquisition expenses. For them, we will only use the renewal expenses. For the policies which are for which we are calculating projected VNB, which are yet to be sold, there we would have acquisition expenses as well as renewal expenses. So the expenses used towards selling those policies would be categorized as acquisition expenses, and the expenses used towards maintaining the policies, maintaining the business would be categorized as rental expenses. So every year the companies do this analysis. This is called analysis of expenses, and they categorize their expenses into these four buckets and derive the total acquisition expense, total renewal expense, and then divide it by the number of policies in each bucket to arrive at the per policy expense. Because for insurance company, all these calculations happen on a per policy level and what kind of policy they are writing, right? And then fourth is basically investment earnings. As I said, for the VIF, for the policies they have already sold, the investment earnings are determined based on the locked in yields or the yields they are expecting based on the investments. But it also reflects a expected market movement, because some of the premiums are expected to come in future, and so there and also there would be some reinvestment uh, portion to the investment income. So while they will use the locked in yield as base for calculating the investment return, they would also use forward rates and current market benchmarks and all that investment speculations methods to arrive at the future investment return, and use that to calculate the expected earnings on the investments they have made. Taxes are also projected based on the future expected profit and the tax rate that companies are experiencing. Uh, they would also take certain assumptions for the bonus for the participating products. Participating products, as I mentioned earlier, is a product that have certain guaranteed components and certain benefits are offered as a bonus each year on year. So LIC primarily sells a lot of participating products. All the products are primarily linked on the bonuses, and these bonuses are declared year on year. While on a fixed investment scenario, the expenses are while the on a fixed interest for the fixed interest rate scenario, the expenses are more or less similar. Sorry, the bonuses are more or less constant. They may change in the adverse scenario or maybe on a higher, more favorable scenarios. So companies do take certain assumptions, bonus rate assumptions, uh, while basically projecting their cash flows. Again, for reserving, they use slightly lower bonus rate assumptions for while calculating the technical reserves. For VIF, they use different assumptions, and for VNB, they would use some product mix and some product features to arrive at the bonus. And at last, the discount rate. Discount rate is, as mentioned, it is generally in the range of 12 to 16% based on the return an investor is expecting from the investments into an insurance company. Also reflects the risk-free rate plus some margin for the risk they are taking. So this is all assumptions the insurance company use while determining the VIF or technical reserve or projected VNB. If there is any question, I can take on the assumptions now before we move to the next part, which is market case study, where we would see how IEV and market value was calculated for a couple of companies who listed in the Indian market, and how the change in IEV is presented in an investor setting or investor presentations.
Is there a restriction? Can I? Is there any
Yeah.
restriction on the investments to be made by an insurance company? Because when I was earlier visiting LIC and all, they used to say that government forces them to invest in this public issues of government companies because to subscribe it or kind of a thing. Whereas private insurance companies used to say that, no, we don't have any such restrictions, so we invest more intelligently, that's why our premiums are less.
No, so there is a guideline, investment guideline issued by IRDAI, which is used to understand how much money can be invested in what kind of instruments. They have certain restrictions. So up to 40 to 50%, they would have to invest in government securities, and around like 40 to 50% they can invest in the private securities or fixed interest securities. Certain percentage only, and depending upon the product type, they can invest 15 to 50% into a stock, basically equities or basically real estate. And then there are restrictions in terms of how much they can invest in other instruments like InvITs and everything. So there's a investment guideline which keeps on updating year on year. But yes, the borderline is basically up to 50% is has to be invested in government securities. but depending upon the product. So basically, if somebody is buying an unit link product where he is choosing a fund with a 80% equity, then in that case, that proportion can be invested up to 80% in equity. But otherwise, all the fixed interest securities or all the participating products fund or all the guaranteed product fund, they are invested heavily into the government securities and then the corporate fixed interest securities. And as you know, there's only one like public company, right? LIC, and the government heavily controls their investment, so they force them to invest in the kind of securities they want. While the private companies, they have that leverage to invest more intelligently to into other instruments available.
There is one question like
Yeah.
in assumptions there are taxes. So by taxes they mean that profit tax, or is it about the insured is paying the taxes?
No, no. Insured is paying tax is basically they are collected from the insured and paid to the government as is. Those are not assumed anywhere in this calculation. These taxes are basically taxes on the profit. Say suppose insurance companies also have certain tax rebates or basically option to carry forward their losses up to certain years. So basically, based on that, they calculate their future profit and uh, calculate their expected tax payments on the profits.
So that is expected because it is assumption based.
Yeah, yeah. So basically, currently, for a company which is already profitable, the tax rate is assumed as 14 point something, 14 plus something.
And in expenses case, there is a deferred acquisition expense. Can you explain that? DAC.
Deferred acquisition expenses. Okay. So deferred acquisition expenses would be for the projected business, I guess, for the projected VNB. Or maybe, as I mentioned earlier, that they would hit to the adjusted net worth, the expenses which they have made and expected to have a long-term benefit. That would be called as deferred acquisition expenses, not the immediate ones. Like if they have subscribed to a system which is going to be used for 10 years, or they have developed a system or invested in the marketing which would be used for 10 years, they are not booking all the expenses in the current year itself, then it would be deferred acquisition expenses.
Oh, yeah. Thank you.
Is it true that LIC expense ratio is less because they pay government salaries and private insurance companies pay higher salaries, so their expense ratio is more? Is it true? Or?
It is government LIC salaries are also basically governed by the government pays, right? They have a lower salary, so actually in LIC would obviously get lesser than the actuary in a private company. And LIC does not spend the way other companies spend on marketing. They have a lot of foot on like roads who are doing man-to-man marketing anyways. And LIC is heavily based on agency model, which is again a lower expense ratio channel as compared to the bancassurance and online mode, which is used by the private companies.
One more small class query. Is it also you give a higher valuation to LIC because all LIC payouts are guaranteed by the government of India? Is it true? Or? And private insurance companies don't have that kind of a government guarantee payout?
No, in fact, it happened other way around. It happened other way around. When the listing happened, no, it happened other way around. The private companies got listed on the EV multiple of 4, and the LIC got listed on the EV multiple of 2.
This happened in spite of the government guarantee for all the LIC payouts.
It is basically, see, an insurance company, they even if the government is not guaranteeing, the the cash flows are more or less secured because they keep a sufficient reserve, which is called technical reserve, and they also keep certain solvency capital on top of that. So, anyways, the payouts from the insurance companies are more or less secured, uh, uh, except the cases like COVID or something where the huge cost towards the death payout have happened. Otherwise, the benefits are secured for all the companies. But yeah, even though the backing is there for the LIC, they got listed on a lower EV multiple. Not sure why, but yeah, it was the case actually.
So is it due to value in new force business they will get? Because value in force business they have good and goodwill also good, but they are expecting not a higher business.
Probably that was
due
when
to high
we were
competition.
analyzing this. This also came to our mind because private insurance companies, they have a different product mix, right? They are selling more of guaranteed products and
Correct.
more term insurance business, while the LIC, they are selling more of participating products where the VNB is on a lower side.
Value in force would be higher, but value in new business would not be so much higher.
Exactly, right. VNB would be lower because the business mix includes like LIC sells around 70 to 80% of participating products. So they would on their projected income, they would earn only 8 to 10% of the VNB, whereas a private insurance company would be selling 40 to 50% of guaranteed products, or maybe a term product, 10 to 20% of term products, they would have higher VNB.
So the term product would higher margin. That's why they have higher BNB. Is it in this case?
Yeah, they have a higher margin because of the size of the premium also, because right. So in absolute terms, it is very difficult to write a 1 crore premium in case of term insurance because the case size would be small. Whereas 1 crore premium in a endowment or in a participating product is easier because case size can be very high.
Understood.
So moving on, we can see the next. I have taken two examples over here. One is, sorry, my miss. SDFC. No, okay. We have taken two examples. One is SDFC Life and one is SBI Life. We have taken their market cap at the time of listing and their market cap as recent as 31st March 2024, and how their EV and EV multiple moved from there. So, see, as I mentioned, LIC got listed on 2 EV multiple. So if you see currently, 2 to 2.5 EV multiple is what looks like a benchmark and the correct market value for any insurance company. So HDFC Life also listed on 4.7 and SBI Life also listed on 4.23. IEV in case of HDFC Life was 12.39 crore, 12.39k crore. And in case of SBI Life, it was 16.54k crore. Their market cap was basically relative to that based on the multiples. But if you see current market, the EV have moved for HDFC Life from 12,000 crore to around 47,000 crore. And for SBI Life, the EV have moved from 16,000 crore to 58,000 crore. So this gives their growth rate in EV and how much projected business have been converted into EV, basically, or value of in-force business. And as we can see, the multiples are basically now in the current market are hovering around 2.3 and 2.4. Whereas if you see LIC today, it would still be at the same multiple level where they got listed. I'm pausing for some time to just for you people to see and understand these numbers.
So in this case, IEV of SBI Life has grown from 16 to 58, but multiple goes down from 4.23 to 2.44. So is it also due to some business? Why IEV has grown, but multiple has gone down? Why that's so?
So see, multiple gone down from 4.7 to 2.3 for HDFC Life.
Correct.
Because this value at the time of listing, 58,000 crore, was derived based on the market price for their shares they have given in the IPO. So this was done on the basis of valuation they have got from the valuer, or from the valuation they got approved from the SEBI, right? And now the current market cap is based on the market prices, which are based on the demand and supply of the company, market prices in the stock exchange. So in their uh, private valuation, they would still be showing higher valuation than maybe 1 lakh crore. But this is 1 lakh crore is a current valuation based on the market price and the number of stocks in the available. And if I'm not wrong, I think HDFC Life is trading at 600 something. And almost a month back, when the surrender value regulations were not there, it was trading at 750. So to that extent, they have already come down. The valuation have came down because of the changes in regulation in the recent times. So now, if you see, the EV multiple will keep on fluctuating between 2 to 3, I guess, based on the news and the demand in the market for their shares.
So EV multiple for unlisted space would be down or similar like would be?
So if for unlisted shares, it would be depending upon how the company is showing their value, right? For the company which are not listed, the value is entirely depending on how we are valuing and how much we are valuing. For listed company, basically the market takes the lead. So the next and the last slide is basically a market case study. How the VNB, just wanted to show
There
how
was
yeah.
one question from the last you said. Like you said for LIC when it was issued and now at the time of listing and at present, the EV multiple has not much changed. So they are not able to realize
Right.
much business. Is it a negative point?
I don't think so. Basically, if their EV multiple is not changing, that means the valuation for their company, or they are realizing whatever they proposed as is, and their demand, the market price have not changed with respect to demand and supply the way it has changed for HDFC Life and SBI Life. And also they have not built that kind of EV depends on the EV multiple, like is basically a reflection of how the projected VNB would be. Projected VNB in turn reflects what kind of product portfolio they are expected to write. So at the time of listing, HDFC Life and SBI Life would have proposed a different product mix than LIC. As we were discussing, LIC would have proposed a higher participating product mix where the VNB is lower. So that is why their EV multiple is on a lower fluctuation side. Company who would have basically shown higher term proportion, and if they and hence a higher VNB, if they are not able to realize that higher term proportion, then their EV would be lower, or the valuation would be lower as compared to what they have projected. Anyways, these are speculations. When the prices are determined by the market forces, uh, this is what would happen. However, I am sure that HDFC Life or SBI Life would still be showing their valuations based on certain higher multiples than the EV. So this slide I have taken from one of the investors presentation, the recent investors presentation of HDFC Life, how their IEV have moved from 395.3 billion to 474.7 billion over the year. We can see the EV have two components over here. One is value of in-force business, which is WAVE, and adjusted net worth. As on 31st March 2021, the adjusted net worth was 127.8 billion, which moved to 145.3 billion. This would have happened due to the profits they would have realized, basically adding to the shareholder surplus. And as you can see, they have given some dividends also. So less the dividends they have distributed, and the value of Info's business moved from 267 billion to 329 billion, which would have moved because of the 1 year new business that came in, vis-a-vis the whatever policies they would have, whatever policies would have got out of the books because of the surrender and maturity or death benefit payout. And obviously there would have been some changes in the assumptions, which if we look at their L forms, which are mandated by RDI, we will get to know what assumptions they have changed and how they have changed. And so you can see their EV changing basically around 17.5% from year on year change in EV is basically 17.5%. So this can also be considered as growth in profit for, in a way, growth in profit for the company, 17.5%. I think this is it from my presentation. And if there are any questions to ask, happy to answer. And is there anything to discuss? I can happy to discuss.
In this slide, what is this unwind portion?
Unwind portion is basically would reflect multiple things here, because they are not only considering anything towards EV, it is combined for EV and IEV. So unwind portion would have the profits from the last year, basically, or profit realized over the year, plus, yeah, it would have primarily the profit from the last year.
So basically policies which are matured and the profits earned on those, or it's
yeah,
also
those matured or
continuing...
basically benefits have been paid or other stuff.
Okay.
Whatever policies they are going out of pool, right? So as by in-force policy, we mean that the policies which have basically which are there in the system, and there is some benefit due to the policies irrespective of their status in the system, whether it is basically a reduced paid up, whether it is deferred policy, or where it is a continuing premium paying policies, or where it is a not premium paying policies. Those policies going out of books would either give me losses or profits depending upon the assumptions I have taken and the experiences I have seen.
Right.
So this would also have basically maybe we can say a discounting impact also, because EV is nothing, VIF is nothing but your future cash profit of present value of future profit, right? So if you move 1 year ahead, the unwind would basically the realizing all other assumptions for a 1 year period and the present value.
Right.
So unwind will also include that surrender profit or loss.
Yes, it would. Because VNB they are anyway saying as a separate item, right? VNB is basically whatever new policies they have written in one last year. So this 35 billion is towards is a new profit added to the VIF towards the business they have written over the last year from 1st April 2023 to 31st March. And economic variances would be basically change in market conditions. Obviously, the returns they would have generated, or other factors, then those are important. Like the change in the valuation as well for the invested. I think we still have some time and can take any questions. And happy to provide more information or any other further follow-up questions. You can send me over the email or WhatsApp on this number.
Vikas, Devashish has asked one question. Bank invest in the shares of life insurance company. For RBI compliances, once in a year, they have to value the value of their investment. What is the best practice of valuing it?
Sorry, can you repeat?
You can see the
I
chat.
wasn't-
He has written in chat.
let me see. Yeah, banks invest in the shares of life insurance companies for RBI compliance. Once in a year, they have to value the value of their investment. What is the best practice to value it? I think they would do on the market value. If those are listed companies, they would do on a market value, whatever share price basis. And if it is not listed, they would certainly take valuation from the companies or valuation from any uh, basically actually to support the valuation. Is that answer your query?
Yeah, I think he has written in the chat.
Yeah.
Anybody else have any question? Please feel free to ask.
No question, just can sir share the PPT with us for future reference?
Yeah, I can. I will share the PDF version of this PPT with Vijay Lakshmi and she can forward.
Thank you.
Because any part of the slide which you want to cover more, because we have some time with us. So any part of the presentation you think you can add some maybe another value or any point to it?
Yeah, let me see. I'll spend some time on.
Yeah.
We can spend some more time on understanding the assumptions, maybe. As
Definitely.
I mentioned.
Yeah.
So and how sensitivity these assumptions are. So for a company like LIC, the valuation would be more sensitive to the interest rate and bonus rates they are assuming, as compared to the company like HDFC who have more pure protection business. Their business would be more sensitive to the interest rate assumptions. Sorry, incident rate assumptions for mortality rate or morbidity rate. So because we do per policy valuation and per policy calculations, the product which are pure risk in nature, like term insurance products or critical illness products and annuity products, they are very sensitive to the mortality rate assumptions we are using or the critical illness rate assumptions we are using. So the valuation would change if there is any change in these assumptions. So, and similarly, for policies like ULIP, for policy like participating products and the guaranteed investment products like endowment products, the interest rate assumptions, expected earnings on the investment return assumptions would have a significant impact on the valuation. The policy discontinuance rate or the lapse or surrender rate, generally the impact will go in which direction is not cannot be uh, very straightforward or cannot be said without looking at the numbers, because as I mentioned, there would be certain policies which would give us losses on the lapse or surrender. Some policies would give us profit in the lapse or surrender. So policies which are surrendering early or lapsing early would lead to losses because the insurance company would have spent higher on the acquisition cost, would have paid higher commission for the first year, and would have kept a lot of money aside for as a reserves and solvency capital. So if such policies surrenders or stops paying future premiums, the company incur losses because whatever expenses they have already incurred toward acquiring that policy may not get covered from the premium they are paying. And primarily that is the reason why we see there is no surrender value. We have seen in past that there was no surrender value in the year 1 and 2, and the surrender value used to start only from the year 3, which have now changed vis-a-vis uh, the new regulations which have came last year or this year, early this year, as on 31st March 2024. They have introduced the surrender value even in the first year, and because of which you will see the insurance companies would price their products, reprice their products, and the benefits in the products like survival benefit and the maturity benefit would come down, or the products will become slightly costlier as compared to the earlier products. So if the policies are getting surrendered or lapsed in the initial years, company may incur losses. If the policy is getting surrendered or lapsed in the later years of the policy term, the company may get profits in two ways. One is basically uh, they would have uh, uh, they would have released the profit earlier, and the second is basically somebody have taken policy in the maybe age of 40 year. At the time of surrender, he would be 50 year, so he would have higher probability of getting death benefit, and the company would have higher probability of paying him death benefit. If that policy going out of the book, their expected payout towards death benefit would reduce, and hence their profit would increase. So basically, one of the components which I'm going to reduce would basically reduce. So that is how the profit would increase. The expenses, this is very tricky actually. A lot of companies, almost all the insurance companies, they are still running on a over expense uh, scenario, where they have spent a lot. Like if you calculate their acquisition expense in the current scenario or the actual acquisition expense toward policy, the per policy expense would come at least 100% to 200% higher than what they have assumed in their pricing or what they assumed uh, in their valuation or IEV calculation. So that is not the actual expenses they assume. They basically try to amortize or maybe defer the expenses as much as possible to take the so that their IEV is not getting hit by the expenses they have incurred. And to certain extent, it is also right to do because not all the acquisition expenses they spend, like more marketing expenses or the higher bonuses or salary to the employees, sales employees, are towards the current business. It is also for the future business and would go impact the future business as well. Discount rates are generally fixed by the insurance companies, and using a 12 to 13% discount rate is standard practice. It is also linked to the investment yield investor expects from the investments they have done in the market, right? Taxes, bonus rates, and discount rates, these have a straight way impact and not that significant as compared to the above first four assumptions. First four assumptions are very crucial and can make or break the valuations of a insurance company. And for all of that, they follow the guidance notes and actual practice standards to arrive at these assumptions, basis for these assumptions, and also to arrive at the margin for adverse deviations uh, while calculating the technical reserve. So primarily in all scenarios, like life insurance companies keep calculating the present values of their future cash flows, be it VIF, be it technical reserves, be it the projected VNB. The assumptions are the key differentiators between these numbers, apart from the components like tax bonus rates and the discount rates that we assume.
So as you mentioned about that, surrender losses can also be there if the person surrenders. So the
Yes, yes.
companies, matlab, as of my knowledge, they can balance with the surrender charges they usually have.
So surrender charges are not like something which an insurance company can apply on the go. Uh, for a endowment product, what happens, or for a term insurance product, or for a product where all the benefits are guaranteed, the surrender benefits are also guaranteed, and they are basically set up in advance, right? The policyholder at the inception knows how much surrender value he is going to get if he pays premium till that date. And surrender losses would not only happen because of the reason that uh, the 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 policy uh, the policy had surrender value, because the company would try to build a surrender value which is basically, which will give them a profit, or maybe not profit or not loss scenario. Because what happens at the time of pricing, IRDA insists an insurance company to keep to show surrender losses. Like there should not be a scenario that if surrender happens, an insurance company is making a lot of profit. So what would happen? There would be an incentive for insurance company to let more surrenders happen, right? So that is why the products are developed in such a way that surrender may have profit or loss depending upon the market condition or the experiences they have vis-a-vis that policy. It's a very thin line. Uh, Slightly lower investment income as compared to what they have assumed, and surrender happens, there would be losses. And we all know that the insurance companies already spent higher than what they are assuming in their pricing rate. So acquisition expenses are way higher than the what is assumed in the pricing. So if the policy is going out, there are chances that there would be losses. Even if there is a surrender charge, those are not applied on top of the surrender. But in case of ULIP, yes, the surrender charge is applied on the fund value, and there is a surrender charge rate. There are less chances of having a surrender loss. Uh, but there won't be much good chances of having surrender profit as well, because IRDA don't allow you to have a product which are surrender profit products.
And they need to balance insurers' interest also.
Exactly. So they would do a sensitivity. Basically, what IRDA does at the time of product pricing, when we actually file the rates with IRDA for approval, they ask for sensitivities and then see how the profitability behaves in case of surrender. It should not be the case that in all scenarios the profit is generating if the surrender rates are increasing. In some scenarios, it should show you a profit. In some scenarios, it should show you losses. Like in certain policy terms, in certain policy combinations, it should show. And they also ask for uh, basically different surrender assumptions, like sensitivity at different levels, like increase the surrender rate at initial years, decrease the surrender rate at later years. All of that also they ask before they approve the product, uh, to check whether the product is surrender supportable or. And surrender is one of the very crucial assumptions. Like it may turn around the company in any direction. The higher surrenders, suddenly the future premium incomes will stop, and the future VNB what they have projected, or EV also would then will not grow at the same rate as they have expected, because EV is a lot more dependent on the present value of future profits towards the business which have already returned. Higher surrender means that I would not earn the premium which I am expecting to earn in the EV calculation. So lower premium income, obviously lower expenses, but the see EV is a present value of the positive cash flow, right? So if I have lower premium income, then obviously there would be lower losses. So the premium has to come to reflect the projected VNB or projected EEB calculation. But the insurance companies, they also take due care in choosing these assumptions for lapse assumption or surrender assumption. It should not be the case that I have assumed, suppose, a 20% lapse rate in year 3, and a 10% or a 30% lapse rate should give me a significant impact, significant hit. So I would choose a lapse rate assumption based on past experiences, but also on the like keep it on a safer side so that my sensitivity towards lapse is not very significant. If it is, then we will have to modify the benefits accordingly so that the sensitivity is not that much. In the current market, basically all the term products are very undervalued, and probably the best time to buy term insurance product would be last 1 year. Like after COVID to this period is basically best time to buy certain mortality term insurance products, because we can see further increase in term insurance rates by 25% to 40% in the coming years. All the insurance companies, because of certain assumptions they have taken and their reliance on reinsurance companies, they are continuously repricing their term insurance portfolio, which you would see there is a significant increase over the term insurance rates in the past few years, and this will continue to increase for next couple of years as well.
So
The
Vikas,
reason
yeah, go ahead. You finish
for
and
term
then.
insurance, like, is it the reason that people try to buy it at a later age only? Like before
No,
that,
buying term insurance on later age would not be a good decision, because the mortality rates around age 40, like up to between 25 to 40, it is not, the increase is not significant. It is almost flat curve, and then suddenly after 40 it picks up and the increase in mortality is steep. So if you buy at later term plan at later stage, it will automatically give you higher premium. So you will see the premium changing significantly from age 30 to 40.
and like I have heard that they sell you at up to you are 50 years old only. That they beyond they won't sell. Is it something like that?
There are companies who have stopped selling higher because see their experiences on the deaths at higher ages is still not very credible. It is evolving over the period. So while they assume, and that is the reason why the mortality assumption, which I was telling that they use 50 to 70% of standard table, actually converges into 100% of standard mortality table at the age of 60, 65. So that is because they don't have very credible experience above age 60 or maybe 50. So that is why they try to restrict their portfolio below that. And you would have seen in of late, many insurance companies have started offering the special exit value in the term insurance products. If you surrender a limited premium product, limited premium means you pay the premium for 5 years or 10 years, whereas the policy term continues till age 60 or 65 or maybe 80 or 100. So the policy term would be 30 to 40 years, but the premium payment term would be maybe a 10, 20 or 10 years only, or 5 years only. So for those policies, there is a surrender value applicable, or there should be some value paid to the policyholder if they are exiting the policies in between. But of late, the insurance companies have started offering a special exit value if you are surrendering the policy at the age of 55 or 60, because once the person has reached to that age, the probability of death is basically even higher, and surrendering those policies would take away the risk from the insurer, basically.
because he have already earned the premium, he have already received all the premium, no future income is expected from that policy. But there is a fixed outflow that is there, a projected outflow that is there, and the death probability being higher, and it is increasing year on year, there are higher chances that the company would incur a death cost. So if that policy is surrendered, they would pay some amount now based on the what premium they have been paid, they have received from the policyholder, and they would get away from the risk of paying death benefit. I think there was another question from Silka.
Yeah. Suppose I want to proceed with a life insurance company valuation. What information should I ask the company with respect to, and where do I get all these assumptions like incident rates and all of that? Any particular website you want to suggest, or just general Googling?
Not general Googling. For every insurance company, they are expected to print these assumptions and all the values, IEV and everything in their L forms. So there is a public disclosure prescribed by IRDAI. It is called L forms. If you go to their website and find a public disclosures, there would be different forms which they produce every quarter. So the forms basically numbered L1, L2, L3, L4. And in those forms, they provide all the assumptions. While in the quarterly L forms, they would only provide the change in assumptions. In the annual L forms, they would provide the complete assumptions of mortality or discontinuance rate or expenses or investment earning returns they have been using for the calculation of IEV or for the calculation of reserves.
That means, are they expected to do valuation every year? Is it required? Because to fill the
Not
forms,
valuation, IEV they have to produce every year. So valuation and IEV have like IEV is only one component, while net worth IEV is there in the L forms every year, every quarter. The projected VNB, which is another part of the valuation, will not be available in the L forms, because that is something
no
which is basically
requirement of periodic valuation in an insurance company.
I don't think so. Any specific requirement of periodic valuation for an insurance company, unless they are basically seeking more money. Yeah, it is unless they are seeking private money or they are going for IPO or FPO.
Suggest talking to an actuary and understand or get a report being validated. Is it? Do you think that because actuaries are expert in insurance?
It is basically whenever there is and most of the companies who get their valuation done, they do consult or get it reviewed from an actuary. So I have been basically not for a not for a listed company. I have reviewed couple of valuation reports for a company who are not listed, and there are buyers who have been trying to like invest that money in that company or maybe buying certain stake.
Just in case you're comfortable, you would like to share many more points stopping the recording, your own experience, like you want to share some report or Excel or say something while the recording can be stopped, just in case you have something to share.
There's no specific, I can't take names, but I have
So
seen.
that's why I asked, do you want the recording
Yeah.
to be stopped or you're comfortable?
No, I think I'm comfortable. I not take the specific names and which I have only worked, but which people would have worked. So you would have seen the Aegon Religare Life converting into Bandhan Life. So there was an actual exercise, the valuation exercise done by an actuary, I know. So and before these takeovers, the valuation do happens for the companies. And even if it is not a takeover, the companies, the smaller companies, if they want to sell certain stakes or they want to basically bring new investor into board, or some investor want to exit, they keep the valuation done on a regular basis to produce their valuations in their investors report.
Now, one question I have, because
Yeah.
see, as the registered valuers, we undertake valuation of companies, especially when there are mergers and acquisition.
Correct.
If say, there is a merger and acquisition of two insurance companies, such valuation will be done by a registered valuer, or it can be done, or it should be done by an actuary.
Ideally, it should be like ideally it should be done by an actuary.
Okay.
Not sure. I can get back to you on this question with a specific regulation which requires who should do the valuation. Because see, the insurance company's valuation is highly dependent on the EV number, IEV number. And IEV number is calculated by the insurance company, or it can be calculated by another actuary by taking certain data from the insurance company. So I think the registered valuer would not have like capacity to calculate the IEV number, even if the data is provided to them. Correct. But a qualified actuary, in his capacity, can if the policy data is provided, assumptions is provided, he can do a cash flow model and immediately calculate the IEV for the company and validate the IEV of the company. So
because under the under the Companies Act, registered valuers are entitled to, or they are authorized to undertake valuation.
But they would have to onboard certain actuary to validate the IEV number. Apart from that, other like valuations, see, valuations have different other components as well. Like adjusted net worth valuation probably would also require valuation of all the assets and all the stakes that company have in different companies and other stuff. So for that, registered valuer would be required, or any other registered valuer with a actuary on board can basically seek the entire valuation, to do an entire valuation.
Yeah. So nice. Thank you.
Yeah.
Any further question, anyone?
Mr. Vikas, what are the key risk factors which I have to consider? Say, suppose one insurance company value will be more, one insurance. 1 minute. Yeah, one insurance company value will be more, one insurance company value could be less. What are the key differentiating factors? What I can see till now, whatever I have seen from your presentation, is the product, what they have chosen. Like each product or new business, rather, what you say, there is a profit, each business or each policy has got that. I found it as a differentiating factor. Otherwise, maybe their treasury, their investments, I don't know. Like,
yes.
how do I
So basically,
apart
from the business mix, the assumptions are the key differentiating factor. How the company is basically taking those assumptions and what are the basis for those assumptions. So somebody experiencing a higher lapse and taking a lower lapse assumption, and in future we don't know how those assumptions are going to be. So one have to be very careful and look at the sensitivity of each assumption, how that impacts. Because these assumptions only, they reflect the key risk to the company. The first 4 points: the mortality, the lapse and surrender, expenses, and expected earning. These are the key assumptions, and they pose the maximum risk to the insurance company. So obviously the business mix is important for the IEV as well as the projected VNB. The assumptions are equally important and equally the major factors in understanding the valuation of it.
Suppose I arrive at either WAC or KE, whatever I have taken, either FCFE or FCFF. What do you think I have to consider while giving a company specific risk for this? Like, how can I attribute? You said normally RF is say 7%, but then market rate is say 15%. So beyond that, should I discount for any company specific risk? Listed company, okay, we get more data, but if it's an unlisted company or rather they have started with this and they are in this business say 1 year and they are in the process of listing going forward, not now. So at that time, how can I attribute this company specific risk? Should I consider this, or can I just, and what about a listed company? Even if it's a listed company, should I consider, we call it as alpha, no, in valuation terms.
Okay. So I would say we should take reference from the listed company or the more matured company if the company is new, because most of the assumptions what they have taken they would not have a lot of basis to support, and all the assumptions would be based on the market benchmark. So we can take reference from the more matured companies, and we can compare the portfolio as well, because if you see company like HDFC, they give a different category of products like values, the EV and the profitability numbers as well. So if the company is having different product mix from market, and since we know the VNB or the EV of different products, or we can come to know it from the market benchmarks, we can basically gauge some numbers to those towards that risk, basically towards the risk of valuing the new company. So to answer your question, basically taking a market benchmark for assumptions and profitability towards different category of products and business mix would make more sense in those cases. Does that answer your query?
Yeah.
Thank you.
Mr. Neeraj?
I
If
think
no questions are
that's it
there,
from
we
my
can.
side. Yeah.
If there are no more questions, then I think we can conclude the session with a vote of thanks to the speaker. Vikas, this was a wonderful session taken by you, a very new topic for a lot of us, a very complicated topic which you have with your knowledge made it very simple for people. I think everybody will acknowledge the fact. Please oblige us with this memento. We will be sending the hard copy, this version to you on your residential address also. And we thank you, and we expect that in the near future we will have another opportunity with you taking another session on some other wonderful topic.
Thank you, Neeraj, and thank you all the participants and members.
Yeah, Vijaya, we can stop the recording and we can, I think, conclude the session today.
Thank you so much, Vikas.
Thank you, everyone.
Thank you, all of you. Thank you very much.
Thank you, sir.